Right, so welcome everybody to this webinar. Today we are going to talk about, as always, supply and demand. We're going to cover some basic theory, and I'm going to show you a project that I've been working on, that I've been using to kind of confirm some of the theories that I've had in relation to supply and demand. But as you all know, if you've seen some of the previous webinars, supply and demand is all about liquidity. So liquidity is ultimately the degree to which an asset can be bought or sold without affecting the asset's price. Then you have another term which I refer to a lot, and this is accumulation. And this is typically the accumulation of orders to either push price higher or to push price lower. So on the buy side, accumulation will typically drive price higher. On the sell side, this will be distribution. So the sell side of the market, I mean, they are selling to bring price higher, which is kind of counterintuitive, but if you think about it, our buying is ultimately what is causing price to move higher. And so supply and demand is about the study of price. So you spend an awful lot of time on price charts, looking at price and trying to identify these areas of liquidity, these pools of liquidity, which are ultimately orders of some kind, limit orders, stop orders, stuff like this. And while this does sound maybe a little bit like a technical and difficult, it's not that difficult to do. A lot of people, a lot of educators that I've run into have unfortunately attempted to overcomplicate this whole concept of supply and demand, and it's really simple. Ultimately, if you have a balance in supply and demand, I mean, price is going to be moving sideways. But if you have an imbalance in supply and demand, price is going to be moving higher or lower, depending on if there's excess of buying or excess of selling. And so, I mean, I underline the word here visibly. It's because you can see it on a price chart pretty clearly. I'm just going to show like some graphics, and we're going to go to the charts thereafter. So if you look at this picture, which is a graphical representation of something that you've seen 100 times before, I'm sure, where price races up to an area and then it moves sideways for a period of time. And then you kind of think, well, what's this sideways movement? What's going on while price moves sideways like that? Well, price is filling orders, because within these candles, I've marked them off as having a white line through them, because my software does that. You can see I have white candles here and here, and I've just done that to give me a visual clue as to what's going on. But it simply means that price is moving up and down throughout the period of this candle. And the same is going on here and here. And this up and down price movement is essentially price filling orders. So the price goes up, we fill sell orders, or we hit buy stops. Price goes down, we hit buy limits or sell stops. And the process goes on. It goes up, finds the orders, price temporarily leaves equilibrium, it comes down. It goes up and it goes down. This goes on for an extended period of time. And so if this candle is not there, you might be thinking, well, should we be buying or should we be selling? Well, luckily you don't have to guess. This is the best part. You don't have to guess. You just have to wait for price to show you that it's going to go higher or lower. And when this occurs, when price jumps up like this, well, then you know that this period of what I refer to as accumulation was an accumulation of buying. So we're filling buy orders to move price higher. And so the method is to wait for this to happen. And once you know that price has a price imbalance to the upside, this is telling us that around this area we have thick liquidity, and above this area we have thin liquidity, until we reach something that looks maybe something similar to, I just kind of draw something here, kind of something similar to what we see down here, above here. And this is supply and this is demand. So price will leave, it's moving through thin liquidity until it gets to thicker liquidity, as we saw down here. And this is typically where price will have a bounce, either turn around or do something entirely different. So if we move on to another one here, we have this graphic where you have a period of trading. Let's say this is a day of trading. So we have the open of the day, and here we have the close of the day. So the day opens and price moves up and it moves down, and it moves up and it moves down. And contrary to much belief, people think that price is moving higher and it's moving lower as a result of buying and selling. And while that is partially correct, it's not entirely correct, because price is moving higher and it's moving lower because price is looking for liquidity. And so without unfilled orders in the market, price would not move. If we have a bunch of sell orders up here and price is here, I mean, it doesn't make sense keeping price here. Obviously, price needs to move higher to find these sell orders, which will then bring price lower to the next order block, which is down here, which is to buy. These orders are filled. Buyers enter the market. The liquidity to the upside is consumed by the bullish push higher. Price goes higher. It revisits this area here. And this is what we'll refer to, rather what you'll all know as resistance. We have some resistance here. We have support here. Price comes up, it bounces, it goes down, it bounces, it goes up to resistance, support, resistance, resistance. And so, I mean, if you consider this whole concept of support and resistance, every time price comes to an area and has a bounce, many people think, oh wow, that's a good area. Price comes up to it again. Wow, it's a really good area because price bounced 2 times. And if it happens 3 times or 4 times, many people are going to assume that, oh, this area has, historically speaking, been respected multiple times. This is a good thing. This means that I'm going to sell the next time price comes up to this area. But this is a bit of a fallacy, because if you consider the supply and demand trading model, you have pools of liquidity above price and you have pools of liquidity below price. So each time price comes up, we are filling these, we are consuming the liquidity at one of these areas. So assuming that we have 100 units of currency, this is a completely random number. If price comes up and we have people that are buying, and we have 50 buy orders that are filled when price comes up here, well then the 100 is going to be reduced to 50. And so next time price comes up to it and we have another 50, well, what does that do? Well, that simply completely removes all of the liquidity of this area. And what happens? What does this mean? Well, this means that if price should find bearish liquidity, it has to go to the next pocket of liquidity, which is going to be located above this one. This one is no longer available, it's completely gone. And so everything readjusts. And so this is gone, so price has to go a little bit higher to find it. And eventually this will be depleted, first to 100, then to 50, and then it'll go. And when that happens, well, then this one is gone. Then price has to go higher. And so the whole concept of support and resistance is slightly dangerous, because you must understand that every time price does reach an area of supply, it becomes weaker and weaker and weaker each time. Okay, let's have a look at another piece of graphic here. Here. And so you can see here, assuming for a second that we have an order of 50,000 units to buy or sell. If you look at this and you think, okay, considering the liquidity available at each area, we have 10,000 here, 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 and here. So if someone comes in and buys 50,000 units of this instrument, of this security, what's going to happen? Well, this is going to happen. Price, the first 10,000 of this 50,000 block, is going to consume this. And when that happens, in order to fill the remaining 40, it's going to have to go up to this one. Now we've filled 20, we need to fill 30. We go up to the next one, we filled 30, we need to fill 20. We filled 40, we need to fill 10. We filled our entire order. But what has happened in the meantime? Well, in the meantime, the price has slipped up like so. So this is slipped. I mean, this is ultimately what slippage is. Thin liquidity. So price consumes this and all of these levels. And so by the time this 50,000 unit order is filled, price has moved up from 25 to 45, so 20 pips. But on the downside, you can see we have much bigger pools of liquidity, well, bigger relative to the ones above. And so if 50,000 units comes down here to sell, the liquidity available at this area, which will be, let's say, an institution, they are going to be looking to buy 200,000. So when we come with our 50,000, the institution is going to buy it. And so that our order is simply going to be absorbed. So that'll reduce this to 150. Did price move? No, it didn't. So we have the thick side of the market, which is below price. In this example, the thin side is above price, okay? And so price will always, it has to move in the direction of the thinnest liquidity. Why? Because thinner liquidity is easily consumed. We could see in this example, price went up 20 pips in order to fill this one order here, but to the downside, price didn't move at all. And it'll require another person to sell for an additional 150,000 units to bring price down just 5 pips, in contrast to this 20 pip move with a relatively small order. And so that's pretty much the whole notion of what slippage ultimately is. So if we look at this here, we have a very similar representation where we have the big order and we have a bunch of small orders. These small orders here, and they correspond to these ones just over here above price, and this big one corresponds to those just below price. So this order here of 200,000 units is going to easily consume this, driving price higher. And this is why I'm so interested in currency strength, because currency strength shows you where the thin side of the market is located. And so you have price moving lower here. Why? Well, we have strength in the Canadian dollar, demand for the Canadian dollar, and we have supply of the euro. What does that mean? Well, that means that the thinner side of the market is to the downside, and so we only want to be selling on this particular time frame. We have another example just here where we have the Australian dollar, which is looking quite strong relative to the American dollar. And I emphasize the word relative because while in the American dollar, Australian dollar cross, this pair could be moving higher. The Australian dollar relative to, for example, the Japanese yen could be moving lower. So the Australian dollar is strong relative to the American dollar, but in contrast, but for an Australian dollar, Japanese yen, as an example, the yen could be stronger than the Australian dollar, which is going to bring the price of the Australian dollar, Japanese yen lower. That's a bit of a mouthful there. And so this is why I like to keep my eye on what's going on here. You can see the varying strengths of these currencies relative to one another. We can see we have the Swiss franc here, and we have the Canadian dollar here. So it's probably time to buy Swiss franc or sell Canadian dollar, or we can assume, or depending on where price is on the supply and demand chart, that the Swiss franc is potentially kind of overextended, and the Canadian dollar is also overextended but to the downside. And so you would typically look for this to happen at an important area of supply or demand. So let's go to a price chart for just a second and see what this looks like. If you see here, let's go to a bigger time frame. So you can see here we have, price came down here and price started to move sideways, and you can see these white candles. Let me zoom in a little bit that I mentioned earlier on. These are the accumulation candles. So price moves sideways, and context is absolutely everything here. So we want to focus on context, where these white candles are painted in relation to existing price. And you can see just here we had price come down here, we accumulated, we have a lot of white candles here, and then price moved away. Price went up, we accumulated, and we shot up once again. We have a nice green candle, which is telling us that price left the area in a hurry, and we exhibited strength, and price exhibited strength as it left this area here. We have this micro area of demand, this little white box here, and I say micro because it is qualified on the time frame smaller than the currently active chart. So we're looking on the 4-hour chart, and the color here, the white, tells me this is qualified on a 1 hour. So this is actually a 1 hour area of demand that is visible on the 4-hour chart, and price came pretty close to that. But you'll notice that I mean, price came back to this area here. Well, why did price come back to this area here? Well, you know, I'm going to show you exactly why. And it's going to seem like magic, but it's not magic at all. Okay, so we have this area here, and price came very, very close to precisely that area. I mean, why did it come down to that area almost exactly before it found liquidity to move higher? Well, this is because if we go back to the slides for just a quick second, and I want to go back to this graphic here. Okay, so assuming that price, it comes down to a level like so, and it turns around. The low of this price move here is pointing to the beginning of the buy zone for demand, and this high here, this test of this area and rejection is pointing to the beginning of the sell zone at supply. But for the sake of example, we're going to focus on demand only because this is what we are seeing when we look at the price chart. So price came here. What does that mean? Well, that means that if this is a nice area of demand, which we will qualify based on an analysis of price, we can do this in just a second, then you don't want to be paying a price any more expensive than roughly the lows of the latest retracement to that area. So price in this example came down, it tested the lows, and it had to go a little bit beyond this low. I mean, why did it go just beyond that low? Well, it went on beyond that low because liquidity to the low has been consumed. So in order for price to find, let's say, support, it must go through this low and enter the pools of fresh liquidity. This example didn't work out exactly like that, but we came very close to the lows in here. And we'll probably find that on a 5-minute chart, there's going to be a micro area of demand in here that is lined up exactly to the low of this pullback. And so price came down. We came back to the edge of the buy zone, which is the low here, plus the spread. And this is where price had a very nice bounce. So price, we tested the area, we started to move sideways, and then we had a pop higher. And this is interesting because this is demand. This is a reaction to demand. And so you can consider this to be the parent. You might have heard me talk about this before. This is the parent, and this is the child. This is established independent of any other areas of supply or demand, rather of demand. Price came down, we tested the edge, and then it was released. So here we have the parent, here we have the child. This is demand, this is a reaction to demand. But you can see, well, many say that you should only trade the first retracement. And while that is true, you can also trade following retracements if the reaction to the parent showed great strength. So when price came down, we had a nice departure, doing some damage to the opposing side of the market. And if we have a look here, I'm just going to zoom in a little, zoom out. We just want to look at this here. You can see that we had this area of supply. And why is this supply? Well, this is supply because we had a lot going on here. This is very messy in here. We have this here. So this is a child. The parent is in here. This is going to be a micro parent. This lovely green candle. We have a period of accumulation. This one went deeper, went a little bit lower than here. So what's this push lower doing? It's doing this. It's doing this. It's moving deeper into this pool of liquidity, finding fresh liquidity. We had it here. We had a push, rejection. Price went a little bit deeper. It found unfilled orders, and then poof, then it popped up. This is lovely. This tells you that, wow, we have a lot of interest to buy at this area, from the high of the accumulation and low. Price came back. We challenged the lows once again, and then this is what carried price higher and away. We had this. Price poked into it. We accumulated. We popped up. We moved sideways. We left, we moved above these highs. And this is important because while it's a little bit messy in here, I'm going to draw this off. We had this here, which was tested a bunch of times. And so we had support. You could also mark this off with the trend line, how we had market structure. which for me is just going to be a trend line or a channel. In this situation, it's a trend line. Price tested it, then price cut through it. What does that mean? Well, that means that we have an area of supply that caused price to break the structure of the market. So you ask yourself the question, what area of supply did that? Well, this one here did. This one here did it, right here. We're going to take, because it's a pin bar, we're going to take the whole body. And then we are going to look to the deepest pullback into that area. Where is that? It's right here. So we're going to mark it off like that, okay? Because price came back to this level and then it left. So this is the beginning of the sell zone. We're not going to be selling down here. We're only going to be selling from here and up. Price came up, we poked into it, and we left. We came through, we moved up. We had an accumulation in here. We tested the highs. We moved through it. Then you ask yourself the question, great, this is getting easy. Now we know that we have some demand. What area of demand consumed the supply? This one here did. So this is the next one that you're going to want to buy at. You put your order in here, the position size here, your stop is probably going to go below here, and this is where you buy. And currently price is reacting that. So on this time frame, the 1 hour chart, we have hourly demand driving price. And up here you can see we have a gray box. This is micro supply. So this is, we're going to go on the smaller time frame. This is telling us to go to the smaller time frames. And we have that lovely pattern as we've seen here as well. And this is where price is having a bit of a reaction. But price, this area of supply, has not accomplished anything. It hasn't consumed any opposing areas of demand. And so this is not something that I would be looking to trade at. That said, we'll mark off the low of the box. We'll go down to the 5-minute chart and we'll see how big of a bounce we've had so far. I kind of lost my bearings there. Mark off the test. Okay, so this is where we are now. So we're just having a bit of a bounce at that level. And notice how accurate these are. Price had a test into that area. We poked into the beginning of the area of supply, which is, look at this, price comes down, it pulls back, it leaves. So the beginning of the sell zone starts at the highs of this pullback. Where did price come to? Exactly there. Plus a little bit deeper. So we had a deeper push, and this is where we're having a bit of a pause for the time being. Then you look at the big swings. Wow, well, we had this, price moved down, we pulled back, and now price is going down. That tells us, I mean, this isn't necessarily supply here, but price did manage to retrace to this area and move away, taking out these lows, telling us that there's probably something that's going on here. I'd say this is likely, we had resistance, this area of demand popped up, price left, we'll just mark it off like that. It was tested once, this area of supply cut it out. So this is the next place that we would be looking to trade. This one here. And if we go to a smaller time frame, let's see if I can go to the minute, we can have a look inside and see what's going on inside that candle. You can see here that we have the candle that looks like this. So we have a 1 minute supply. This is really, really tiny, but look at the release from this area here. And this is the one that cut away from that 15-minute demand that we saw earlier. So we mark it off like this. You could take the wick, the lower the wick here, or you could take the body. But this is typically where price is going to have a bit of a bounce on its way up. And that's pretty much how it goes. It's very simple, actually, if you don't overcomplicate it. When you start attaching indicators to your chart and trying to turn it into some mad science, which it isn't, this is when things get very, very complicated, and this is when you get overwhelmed, and it shouldn't be like that. And just as to prove this fact, I've written an automated trading robot that is based on the engine of my supply and demand software, and it's trading on a VPS 24 hours a day based on the rules that I've just showed you. And I'm going to show you, I'll just show you very quickly, like the configuration of it. let's see here. Yes, we'll do that. So here we are looking at, let's not focus too much in this, but what we need to focus on is this bit here, where we have risk to reward ratio, price and balance release period. These two are the most important configuration options in this robot. And what they do is they tell the robot how far price must travel and how little time price must get there in. And this is a good example of that. Price left this area of accumulation and it went, let's see, we have, let's say 8 pips, and it traveled 38 pips in 1, 2, 3, in 1.5 hours. So this is a very highly qualified area of supply according to my software. So it's telling us that, wow, we certainly want to be looking to sell up here. Price has come up here. We've had a little test and price came back. We had another test. And so the first one would have been interesting. This one would have been interesting as well because price left, but now you can see that we formed this low and now we're seeing higher lows. And so I don't think that this is going to be an advisable trade in the future, but I recommend that you mark off the 110.24 area on the dollar yen and just watch what happens when price gets to that area next time. Note that it hasn't gotten entirely to it yet. We're still about 5 or so pips short, 2 or 3 pips short of the zone itself. We're just reacting on the wicks here. And so it's very interesting to see how price reacts. So mark that off and just have a watch when price gets up there maybe later today. So the robot is trading these rules. And I've got the results here. It's running on a bunch of different counts and a bunch of different configurations. It's going to have a look here. And here, this is the past 312 trades. Short positions 1, 100%. The long positions 1, 100%. And we have, there's absolutely no drawdown whatsoever because price is reacting at these areas to such a high degree. 312 a trade, that's a pretty decent sample size as well. If we have a look at another account statement here, we have slightly smaller number here, very small drawdown, and we have very high degree of accuracy here as well, which is just another example of the accuracy of this. It's phenomenal how well these areas hold. And look at that profit factor, 10,773. That's dizzying. It just seems wrong because they say if you can have a profit factor over 1.5 or 2, then it's a thumbs up, then you're doing really, really well. And this strategy just works so well, which has been confirmed by this project, that it's just worth noting. We've got another account here, slightly fewer trades, very small drawdown as well, and very high, a very high number of positions, 1. Average profit trade 42, average loss trade 11, and so the parameters are nice. They are certainly showing us, rather painting the picture of a very stable and profitable trader. And I've got this running on some live accounts, quite a few live accounts as well. This is the past 144 trades. We have a very good accuracy once again. We have a very good profit factor, not as radical as what we've seen over here, but nonetheless. And this is 10% in about 3 weeks. We have another one, which is this one here, which is 1,325. This is a live account. Deposited $3,000 just under 4 weeks ago. And we are up $1,388, and that's under a month. So we'll do the math. What's that? 35, 36%. And look at the hit rate. We have almost a perfect hit rate. It's absolutely staggering. And so I think this is just a confirmation that that it's really worth investing effort in learning supply and demand, but also from a sell side, so you understand the the liquidity distribution and how this distribution of liquidity is affecting price. And also keeping in mind that, price is indeed moving all over the place, as you can see if you look at a price chart, but it's moving because of unfilled orders and not the filled orders. Because, yes, price will go down, but it's not going to go down until we get up to around this area. So price is moving sideways. We have a balance in supply and demand. If we want to create an imbalance, price has to seek sellers. It has to find sellers, which it found when it came up here. Price went down. We poked down into something down here, so we moved into a pool of bullish liquidity here, and then price had a sharp push away. This looks like a very thin liquidity, so likely at the time of news, and into an area of demand. So you're going to see massive spikes like this, and our price is kind of meandering around since then. And notice, you have a crazy spike up, a crazy spike down. This is going all over the place. But keep in mind that even though you have mad news, figures out of one country throw one currency in one direction and the other in another, notice that price will almost always return to the base in order to figure out what it's going to do next. Price cannot go up and just keep going up. It will never happen. It simply can't happen. So price will come down. We'll see a big reaction. But in order for price to find its direction, to stabilize, to find parity, fair value, it has to come back to an area of the market where people are willing to buy and sell. And down here, we could see that people are looking to buy. And when this buying occurred, well, this ultimately drove price higher. So it's really, really, really fascinating. And this stuff keeps me awake at night as I ponder these things and improvements to the software and to the robot. So it's an incredibly exciting study, I think. So there's automated trading, but we also have discretionary trading, and I do both. I'm doing automated trading more as confirmation. It's a tool. It's input into my discretionary tools, which you can see here, and it's tremendous research. Up here you can see that we have a red rectangle. Red means daily, blue means 4 hour, white means hourly. And these boxes up here, you can see that these are dotted, they have a dotted edge. And this is because that they have been tested. And they were all tested just here. The low of the daily 4 hour and the 1 hour supply lined up very nicely. Price poked into those. And then we saw a very, very nice release. And this box had a solid border until price tested it. So now this has been violated. This is just telling you that it's likely that this area will not hold on future tests. So just a nice visual way to trade. And I think that making a trading robot that implements the same tools is just a really good way for confirmation, to ultimately confirm the theory that I'm running around thinking about all the time. Good. Well, I think we've reached the 13:39, so we're pretty close. We're about 5 minutes until we have to finish this up. So I wondered if any of you have any questions that you want to ask. Then I think this would be a really good time to cover those. What do you think, FX Street? I think we're good on time still. So if any of you guys have any questions, it'd be super. We can maybe throw those out there now. I can see there are a handful of people in the room. I'll give you guys a minute to respond. And another thing, while I'm waiting for you guys to type in questions, notice that down here we have red. This dashboard is red. On this one, it's going to be green. And what does that mean? Well, that means that the interest rate swaps for this currency are going to pay returns if you are long the American dollar, Japanese yen. And that's because the American dollar has an interest rate of, I think it's 1.75, and the yen has minus 3/4. And so if you're holding these positions overnight, you're going to be paying swaps. And so it's just a good idea, if you're trading on the longer time frames or with larger positions, that you're earning swaps as well. And so this is just a nice visual indication that I like to use to help me keep me on the right side of the swaps, because it can add up, very much so indeed. Right. No one has any questions. What do you reckon, FX Street? Is the sound still good? I've gone awfully quiet. So I want to make sure everyone can hear me loud and clear. I want to make sure I haven't been rambling on for 45 minutes and no one's hearing a thing. Yeah. Good. Well, I'm not. Yes, excellent, Adam. Good, good, good. Is this stuff interesting? Is it oh, super. I'm super pleased to hear. Is it interesting? Is it surprising, or is it something that you guys are aware of? But either or. I hope it's something that you can use at least. It's a very it's a very simple way to view the market, or view anything really. Anything that's bought or sold, I mean, they play by the same rules, and I find that to be very fascinating. Hey, thanks, Abdul. I'm super pleased you could make it here again. Thanks for your message as well. Very kind. Yeah, they're far in between these webinars. I'm currently in the process of relocating to Indonesia, and we're moving in 14 days, and we have our home is for sale and our furniture is for sale, and so we are underwater in preparing. But it's exciting, and we found a tremendous school on the island of Bali for our two boys, and so we are moving to Bali. It sounds like something you read in a kind of child fantasy book about people moving to Bali, but you know what? People actually do this stuff, which is fascinating. So we look very much forward to going there. And so I'll be doing probably another one of these webinars in about a month's time. I think by that time I should be nice and settled, and the internet should be set up and working well. So that should be all nice and functioning. I did a couple of webinars from Indonesia last year as well when we were over there, kind of checking out the area. So I think it'll be good. Good. I'm so pleased, John. I'm so pleased. Also, Albert. It's really, really good. I'm glad you guys see value in these. Good. Well, FX Street, what do you reckon? Is this? I haven't seen any questions typed, and so I assume that you guys all are good to go. Super good, Amy. Super good. And if you guys want to get in touch with me or have any questions, I can just type my email in here. I'm also on Skype as well, and my Skype handle is sharp, harp, without the R on the end. So if you have any questions about what we're doing, or rather what I'm doing, it's only me at Pipnotic, then feel free to shoot me an email, and I'll be pleased to chat with you. But yeah, ultimately at Pipnotic, I'm just writing these tools and trading, and we're trading live and showing what we're doing, and it's a very exciting environment to be in. We have a bunch of really nice people in the community, almost as good as the FX Street gang. Good stuff. All right, everyone. I will finish up. FX Street. Once again, thank you so much for having me. It's always an immense pleasure. And thank you so much, Abdul and Adam and Albert, Sanchez and Amy and John and Thomas and so on. And yeah, we'll catch up in about a month or so. And if you guys have any special requests, you want me to discuss something, maybe the next webinar, just shoot me an email on the sha@pipnotic.com. I'll also put the website in here. Cool. There's there's my link. You can find me in there as well. Just shoot me an email, and I'll maybe get some time to cover your material next session. Good. Well, thank you so much, everybody. Thank you very much, FX Street, and I'll catch you all again in about a month's time. Thanks for watching.